Hey folks, I wanted to give you a little bit of an update of what we have been talking about to clients for the past, let's call it week and a half or so, and that is one of seasonality. I think it's very important to understand that here in November and December, traditionally speaking, and again, this doesn't apply every year, but on average, I certainly didn't apply in 2018, but on average, you do tend to see higher markets in November, although November doesn't tend to see a huge month to the upside, but then they do tend to see a positive month of December. So I'm going to just show you a couple of charts because our theme here throughout September and October, and we laid this out as early as early August, was that we're going to see or at least traditionally would see at least a little bit of volatility in September, October, where we saw a tiny bit of volatility in both early September and early October. Certainly not enough to really justify, to say that it was an average year. Average year sees a little bit more volatility. Nonetheless, the game plan has been all along to go ahead and start looking at things from the bullish side as we head into year end. Now, there's some structural reasons for that. I'll talk about that in a minute, but let me just show you a couple of charts first. So if you look at something like this is a chart I've showed here on the YouTube channel. I don't know, must have shown it 4 or 5 times throughout the past few months as we are carving out this what's called an inverse head and shoulders pattern. And even though I don't think it ultimately has a lot of room to the upside, I do think it's entirely possible that and we see this pattern all over the place, by the way. It's not just here that we see a pullback and then ultimately another rally into year end. So you get the industrial stocks maybe towards the mid 80s is kind of probably, or not probably, but from right now, kind of like the extent of exhilarating returns we might see, over the next couple months, maybe into January. So that's just one thing to look at. The exact levels aren't that important. There's it's more the structural year-end kind of move that we tend to see. And again, I'll show you the reason. I'll give you the reason why. So that's industrial stocks. Again, breaking out of a base, basically a trend that we've had since April, breaking out of that range, which is the orange or I guess purple or red shade that you have there, breaking out. I think it's overbought right now. Pull back a little bit over the next few days, a couple of weeks or so, and then maybe find a better buying opportunity into year end. You can look at transportation stocks, IYT, also in my opinion, quite overbought, but here too you have this inverse head and shoulders pattern. You can see sort of kind of imagine a right shoulder here ahead and left shoulder a head and a right shoulder here sort of, but we're breaking out. I do think again overbought right now. We pull back a little bit, maybe we go higher. You can look at things like regional banks, something that we're watching very closely. Same pattern here, not exactly the same look to the penny, but the same idea. Left shoulder, head, right shoulder, and we consolidated, and now we're breaking higher again. I think we're overbought right now, but I could easily imagine us pulling back a little bit here, kind of like to the previous breakout point, and then going higher. The point is the market's overbought right now, but into year end, we tend to see that bid. Now, why is that the case? Why do we tend to see that? We tend to see that kind of phenomena taking place because of there's some asset allocation moves that have to happen from an asset allocator's perspective, but also fund managers like your mutual fund and things like that, and even hedge funds, they have to kind of chase performance. And I talk about this every year in the fourth quarter, particularly in November and December. So if you've been following us here for a while, you've heard this before. In the fourth quarter, we tend to see that performance anxiety. Now, 2018, which is everyone's memory, that hasn't been the case there, although we saw a massive rally in late December, right? So it ultimately did kind of work out just in a less traditional sense. But usually you tend to see fund managers having to buy. Basically, the S&P is up like 18, 19% as of here right now, year to date. Most fund managers probably aren't up that much year to date, assuming that's their benchmark. So they have to kind of chase performance, buy winners, buy the market just to be able to keep up with that and hopefully kind of get the momentum thing, play the momentum. So that's why, or it's one of the reasons, one of the explanations that I think resonates with people the most as to why we might see that. So we are definitely, again, sticking to our plan after having thought we'd see a little bit more volatility September and October. We saw a little bit. Not enough to call it average, but we saw a little bit. Now we want to switch and be more constructive. Again, immediate term overbought. That's a conversation we're having with clients. We're showing them a lot of individual stocks, a lot of individual ETFs where we're seeing the same thing. So if you want to become a subscriber of something, you can always leave a comment down below. Let us know. We have the Market Rover that a lot of people love to find ideas how that's place, and we're looking forward to being able to finish the year. I strongly hope this makes sense. If you enjoy this, give us a thumbs up, like, and leave a comment down below. Take care. I'll talk to you soon.